It is no surprise that the stock market is currently at all-time peaks in almost every industry. The S&P 500 has long outperformed the all-time high reached in March of last year, just before the epidemic. Several YouTube people, including myself, have already shown you a lot of statistics, such as the Buffett indicator, that plainly suggests that the market is actually exceedingly pricey in comparison to previous history. So why would anyone invest in index funds when it is evident that the bulk of companies are overvalued? In today's video, we will analyze and demonstrate why purchasing these high-priced stocks may be the best thing you could do in 2021 and beyond. But first, if this is your first visit to our Smart Stocks Academy channel, please welcome my warmest greetings. And to be the first to know when a new video like this is released, hit the like button, subscribe, and click the notification bell next to it on our Smart Stocks Academy channel. And now, let's get to it. We will begin with dollar cost averaging, often known as passive investing. Basically, it is an investing theory that emphasizes diversification from across the entire market while maintaining to add to your investment at predetermined intervals. This method has been well documented and proven throughout history. World-class traders like Warren Buffett and Charlie Munger have long advocated for doing just that.
We may be in a new world, the world that Japan entered back in 1990, and if so, stocks will, when we look back on it, will look very cheap. But, you know, this has not been the history of the United States to have these continued low interest rates. So, if I had a choice today for a 10-year purchase of a 10-year bond at whatever it is, or 10 years, or buying the S&P 500 and holding it for 10 years, I'd buy the S&P in a second.
While it may be tedious when looking at the numbers, this method is tremendously undervalued. Several specialists and fund managers struggle to outperform this simple technique of buying the entire marketplace on a regular basis. This is precisely what the CNBC report from 2019 outlines. The large percentage of big cap funds has underperformed the S&P 500 for 9 consecutive years. In reality, following 10 years of monitoring, 85% of large-size funds lagged the S&P 500, and after 15 years, 92% of large-cap funds lagged the S&P 500. However, this reality still leaves an unanswered question. Why would you invest thousands of dollars of an index fund that is 2 or 3 times overpriced compared to historical norms? Is it worth investing passively now, given the market increased danger? Why don't you just sit tight for a reasonable price? And that would be a valid question that many so-called financial gurus dismiss. Rather than me responding, I'm going to let Jack Bogle, the man of Vanguard and someone who has advocated investment over speculation and long-term tolerance over relatively brief action for over 70 years, do so.
So it shows you that when you act on the emotions of the marketplace, you're making a big mistake. I stay and always have said, stay the course. Don't let these changes in the market, even a big one, that was a 50% decline. Don't let that change your mind. And never be in or out of the market. Always be in at a certain level. You may want to be 50% in the stocks like I am. You may want to be 75% or 25%. That's probably a decent range. But never be out and think you can get back in, because your emotions will defeat you totally.
One of my favorite Jack Bogle lines is when somebody says buy and hold is dead, or when they ask you, is buy and hold dead, what do you say? You always say, depends on what you buy, right?
Well, buy and hold for a stock is one thing. Buy and hold the U.S. stock market is quite a different one. What do we have going for us in the U.S. stock market? Leaving aside how hard it is to pick the winners, how few people really ever heard of Amazon 25 years ago, to say nothing of Google, maybe a little more than that, maybe 30 years ago. So if you hold the stock market, you will, not to be corny, Bill, but you will grow with America. The correlation between the long-term growth of America's gross domestic product, so-called GDP, and the stock market is something like 95. But the annual correlation of those two things is probably 20. So, you're making a good long-term bet, but short-term betting is just not a good way to go.
As you've seen, Jack Bogle feels that not investing money in the stock market is the most dangerous gamble a person could take. If we examine at the S&P 500 over the last 20 years, we can see that despite a couple of major dips and valleys, if you squared out your purchases, you would have gained money. And the majority of people will not explain to you why this method works. At the end of the day, dollar cost averaging succeeds because the S&P 500 has been steadily rising for the past century. Before you dismiss me as pointing out the obvious, allow me to assure you of something most people take for granted. Certainly, there have been long times when our beloved S&P 500 has been stagnant or falling, but it has always returned and surpassed its previous peaks. We, in the United States, are currently unaware of our country's economic miracles. In the previous 4 decades, the United States has seen a period of rapid expansion and development. Regardless of what many may claim, the United States is the world's economic superpower. We built the world's best, biggest, and most progressive firms right here. Other nations are unable to make the same claim. The Enku 500 is Japan's version of the S&P 500. As you've seen, it still hasn't reached the heights it did in December 1989. If you started dollar cost averaging the 9K in 1989 when you were 25, you would still be losing 50% with an annualized return of negative 2.2%. In Japan, the same approach would also have been disastrous. The true reason it works for the S&P 500 is that America has always managed to pull itself out of dire straits. Warren Buffett explains it in this video.
Maybe you were giving a little bit the wrong lesson because all the questions would naturally tend toward current events. And so this time I went back actually to 1942 when I bought my first stock as an illustration of all the things that have happened since 1942. We've had 14 presidents, 7 Republicans, 7 Democrats. We've had world wars. We had 9/11. We had the Cuban Missile Crisis. We have all kinds of things. The best single thing you could have done on March 11th, 1942, when I bought my first stock, was just buy an index fund and never look at a headline, never think about stocks anymore, just like you would do if you bought a farm. You just buy the farm and let the tenant farmer run it for you. And I pointed out that if you'd put $10,000 in an index fund that reinvested dividends, and I paused for a moment to let the audience try and guess how much it amount to, and it would come to $51 million now. And the only thing you had to really believe in then is that America would win the war and that America would progress as it has ever since 1776, and that American business, if America moved forward, American business would move forward. You didn't have to worry about what stock to buy. You didn't have to worry what day to get in and out. You didn't know the Federal Reserve would exist, whatever it might be. And America works.
So it all boils down to your faith in America. I understand there has been a lot of negativity around the country in recent years. Yet, America remains the undisputed leader in practically every creative technology you can conceive. When it relates to the performance of our businesses, we Americans are a little privileged. While there are issues, there is no doubting that the internet you're using currently, the media platform you're surfing, and the device you're using are all because of America's commitment to innovation and relentless drive to achieve and surpass standards. Those, therefore, are the results of the commitment of substantial profitability. So, if you genuinely think the United States will maintain its enthusiasm, if you trust this country was founded on the commitment to providing people with the right to life, freedom, and the American dream, then buying at any high point is guaranteed to be followed by a long term that it outperforms over and over again. That is the American way, and worth the country's biggest and most successful 500 firms, which encourage innovation and prosperity and reflect that essence. Although some may find the realization that this country's character and development can be evaluated by the success of its greatest corporations disconcerting, it is undeniably true. While there are issues that must be addressed, companies are the heart and cornerstone of this society, and they play a significant role in determining the quality of living in any area of the globe. They generate income, which in turn generate taxes. It should come as no surprise that 50% of all taxpayers pay 97% of all income taxes. Thus, the earnings generated by these corporations that are boxed up in the huge S&P 500 is essentially supporting and funding this powerful half. And with that, today's video comes to an end. If you haven't already, hit the like button to show your love and support for the Smart Stocks Academy channel. Also, subscribe and turn on the notification bell next to it to be the first to know when a new video is posted. Thank you for stopping by to watch, and I hope you enjoyed it. I hope to see you again in the next episode.